All right, guys. So in today's video, we have the full conversation with Tim Dineen. He is a mortgage loan officer, and I wanted to upload the full conversation. I've been kind of sprinkling bits and pieces through YouTube Short and the Instagram Reels. So if you've seen some of the short clips, here is the full video. Enjoy. What is up, guys? My name is Jordan Miller. I am a real estate agent in the Northern Virginia market, and I'm sitting next to...
I'm Tim Dineen, a local mortgage professional with Keystone Funding. I've been helping people buy and refinance homes and invest in real estate for about 10 years now. And this is my home, this is my community, and I just love helping in any way I can.
Nice. All right, so Tim, what got you into becoming a mortgage loan officer? What drew you to it?
Sure. So I was always into finance, right? When I was a young boy, I was the kid who loved the movie Wall Street. I think I can thank my mom for turning me on to that. She was a big Michael Douglas fan. Always had the Wall Street Journal at lunch in high school. I was kind of a nerd. Going through college and then 9/11 happened. The timing just didn't make sense for me to go into finance, right? I always thought I was going to work on Wall Street, and then there was all this turmoil in New York.
Yeah.
So I went into a different career. I spent a career in retail management for 10 years, and I met someone who ended up being an advisor and my boss and business partner of mine. And the timing was right, and the reason we met, he was the loan officer that helped us buy our house.
Oh, wow.
And so, I started talking to him, and it was just, it's a very long-winded answer.
No, you're good.
I started talking to him, and I knew that it was time for a change. And it took me a couple of years to get through the "am I going to make it" phase of mortgages. And 10 years later, this industry has created some amazing friendships and business partnerships and great opportunities for myself and my family. And glad that I made the move.
I love that. I love that. Now, this is something that I've kind of heard about, but when it comes to the mortgage term, 30 years is kind of typical, right?
Sure.
Do you think we'll ever see a 40-year? Is that something that you've heard about, or?
Yeah, so it's typical. The 30 year is very typical because of the cost of home ownership, right? I'm not saying it's going to, but let's say the cost of home ownership
Continues.
Yeah, if it continues, or I was just going to say if it went down considerably, which again I don't believe that, then a lot more people could afford a 15-year or 20-year, 25-year. Nobody talks about the in between, but you can do custom terms on mortgages, and people who are trying to retire and get rid of their mortgage, they do that.
Yeah.
But the 30-year is really pegged because it creates more affordability in the monthly payment.
Exactly.
40 years exist in the non-traditional products, right? And in lending, it's all about layered risk, right? So if someone has poor credit and a small down payment, then there's only so much more risk that a mortgage company can take.
Yeah.
Where the 40 years exist is for the big down payments, for great credit, and investment property. That's where I've seen it. The majority of the products that we do and most lenders do, right? We refer to ourselves as retail lenders. So most lenders that you speak to, it's all going to be like Fannie Mae, Freddie Mac, FHA, VA loans.
Okay.
But then we can also broker out the specialty products, and that's where I see the 40-year loan.
Gotcha. Do you see the 40-year you think coming to
traditional lending? I think if
home prices continue to go up.
Yeah, and I think what we've seen the last 12 months or so is, or we've kind of seen it on the opposite side, right? When rates drove up, affordability was crushed.
Yeah.
And now they're trying slowly to do it the other way.
Drop the rate.
Yeah, so I think you're onto something. You've got to have some equilibrium between prices, rates. And income. And with inflation, then everyone else's cost of goods went up too, right? So it's just, I don't want to complain, but you're spot on. But yeah, I don't know the answer to that. But I think it's probably not out of the question.
Okay.
Yeah.
Cool. So you're licensed in Virginia?
Yeah, so I'm actually licensed in 18 states.
Oh, wow.
Yeah,
Oh, wow.
the majority of the business we do is here locally, right? We help real estate agents and clients in Northern Virginia, DC, Maryland, but I'm licensed in most of the East Coast, Texas, Colorado, California. So if there's any referrals out there, I would love to help anybody. And if I can't help, I'm happy to answer any questions and then pass them off to someone I trust.
Nice.
Yeah.
So from the standpoint of, let's say, a renter, somebody wants to make that big move. They want to purchase their first home.
Sure.
What are some of the requirements involved with getting pre-approved?
Sure. So I think if you're renting and you've never stepped into the pre-approval process at all, I want you to first believe that it's possible, right? And once you have that mindset, then I would take a hard look at your credit report, right? Some people are really qualified, some people are not, and most young people just don't know where they stand. And my biggest frustration or empathy when I talk to someone is, I wish I'd talked to you a year ago. Because usually by the time they talk to me, they've already identified the house and they're ready to go, right? Whether it's mentally or physically, they are ready to take action.
This is the one.
Yeah. And so we got to reset that. But yeah, I mean, getting your financial house in order. The mortgage industry has changed over the years, and there's so much federal backing that you don't have to be a perfect candidate. You don't have to have a huge down payment, but you've got to have a stable job. You've got to have credit history. You've got to meet minimum requirements, and you've got to have some money to make this happen. But again, there are programs out there where you can do little to no down payment. Really, depending on the program, from a credit score perspective, I would really be shooting for 600 or higher.
600, okay.
Yeah, and again, depending on your situation, there are potential to do it less than that. Depending on how low you go, you got to come up with a bigger down payment. If you're borderline with credit, I am not a licensed credit advisor or anything like that, but I will tell you, I've looked at thousands of credit reports, and I have trusted industry professionals that I can pass you on to, right, if you need real heavy lifting with credit.
Okay.
But when it comes to just the basics, do X, Y, and Z, I've helped my friends and family better their credit for the last 10 years, and I'm very passionate about that.
Very nice.
Yeah.
So credit obviously being one, debt to income and income, how does that usually play out?
Yeah, so if we're talking about Northern Virginia, right, it's expensive to buy a home,
For sure.
right? And so for a young person, especially, debt to income can be a challenge, right? And so my first piece of advice there, if you don't have a car loan already, and home ownership is part of your equation, wait to buy the car till later on.
Okay.
And a good example there is if you make $5,000 a month,
Okay.
and you have a $500 car payment, well, $500 might not seem crazy.
But
That's 10% of your purchasing power.
Oh, wow.
And that would hurt my heart to see, someone not qualify because of that. And I would say that happens a couple times a month when I'm reviewing credit, and it's avoidable, right?
Yeah.
So drive the beater a little bit longer, take the bus, Uber, if homeownership is on your radar for 2024. But from a debt to income, we're really, depending on the program, somewhere between 45 and 50% debt to income, right? So it's gross, your monthly income, your salary, and if you have variable income, you're a nurse, you're a contractor, then it's our job to analyze it and go through all your documents. But if you're a straight W-2 salaried employee and you make $5,000 a month and you carry no other debt, best case scenario, you're probably looking at a mortgage payment of about $2,500 a month. And then the other side of that is, just with the cost of home ownership is how much do you want to spend?
Yeah.
And often people, they'll ask me come up with the highest number I can qualify for. And then they'll tell me to take a hike when I tell them the payment because they don't want to actually pay that, right?
Yeah.
And so,
Yeah.
I'm a firm believer, and you'll hear this over and over. Everything we do in life, there's a sacrifice, right?
For sure.
And if you have the perfect home in the perfect area and the perfect yard, the one thing that you're going to sacrifice on is monthly payment and price. And so you just got to decide, what's the most important to you.
Makes sense.
Yep.
Now, I get asked this question a lot, and it revolves around points.
Sure.
What are mortgage points? What does that mean?
Sure. So I think somewhere way back when someone was like, let me create this nomenclature about talking about the mortgage industry and make it sound good, but it's actually kind of bad, but wait, it's kind of good. So points have a very negative connotation, but what they literally are prepaid interest, right? So an example is if you have a 7% interest rate with no points and you have 6.5% interest with 1 point, then you are paying 1% of the loan amount for the lower interest rate.
Okay.
And around here, if you were buying a $400,000 house, 1% is $4,000, right?
Okay.
So what's my payment savings versus the $4,000? Yeah, and then that's the math, and that's how you see how many months it's going to take you to break even.
Okay.
And then once you know the number of months, then you decide, okay, how long am I going to live in the house? How long until I refinance, right? And just making sure that if you do pay points, that it's not a sunk cost that you're not going to recoup.
So with the points in mind, let's say that $4,000, that's an upfront cost that you would pay out of pocket?
Correct. So that's the negative side of it.
Okay.
The positive side is you get the lower interest rate.
Exactly.
Yeah.
Exactly.
And that's why they call it a discount fee.
Okay.
Discount points fee. Yeah,
Okay.
and they're kind of used interchangeably.
Nice. When it comes to refinancing, when do you think would be a good point to refinance if somebody's thinking about refinancing?
Yeah, so there's a couple different ways of looking at that, right? So if you are, if you're looking solely at interest rate, right? If you have a conventional loan, no mortgage insurance, and your new loan is going to be a conventional loan, no mortgage insurance, I would say typically around 1% seems to be where there's enough rate reduction that we can do it at a relatively low cost, and it's still a benefit that makes sense, right? Because you still got to apply that same test to it. Are the fees going to outweigh the amount of time left to recoup it, right? So like if you were, for example, if you're going to sell your house in a year, you're probably not going to refinance.
Might as well just wait.
But there are so many other reasons to refinance that don't get much spotlight, right? So if you can remove mortgage insurance, depending on your loan amount, your credit score, that might be removing $400 or $500 a month on the high end. That would be huge. So if you could get a slight rate reduction, and we're all hoping rates come down this year. So if you get a slight rate reduction and you can remove mortgage insurance, that could be a game changer. That's another reason to keep building on your credit, regardless if you've bought the house yet or not. You could take cash out, right, potentially for whatever you need, right? Some people take it out for home improvements. Some people take it out to invest in more real estate. Some people take it out to fund their kids' college for home improvement. There are things that happen, right, that aren't like the happiest things to talk about, but sometimes you get divorced, right? And that's common. Refinance, like having to pay out the other spouse.
Okay.
That's yeah.
Okay.
So.
All right. So when it comes to PMI, what is PMI, and when does PMI drop off of a loan?
So I mean, PMI negative connotation. I think it's important to think about your whole financial situation, right? If you have great credit and two borrowers on a conventional loan, PMI is relatively not as expensive as, say, if you had bad credit on a conventional loan or FHA mortgage insurance. And so I'm going to get back to directly answering your question. PMI, I often have conversations with prospective clients, and they think it's like something that they're choosing to do to protect them. What PMI does is it protects the lender in the case that a borrower defaults or forecloses on their loan. You know,
Okay.
and so the threshold that's been set is 20% equity.
Okay.
So if you're buying a home with 20% down or more, or you're refinancing with 20% equity or more, then you don't need mortgage insurance. If you're close, right, if you have great credit and you've got 15% or 10% equity, there are options, sometimes economical options, where you can just do a one-time PMI buyout, and so that way you don't have it monthly.
Gotcha.
I do want to also point out, right, if you're putting 3.5% down and you go FHA, that mortgage insurance is for the life of the loan. So it's something to think about, right? If you can try, if it makes sense for your financial situation to go conventional, and there's a lot of things to think about there, then one of the benefits of an FHA loan, one of the negative of an FHA loan is you have mortgage insurance for the life of the loan.
Okay.
The positive conventional, it does eventually drop off when you hit 20%. Yep.
So starting with an FHA loan, could you then refinance into a conventional loan and drop?
Yeah, and that's a very common practice,
Okay.
where people put 3.5% down, go FHA, or maybe they piggyback it with a government program where they get the down payment assistance.
Yes.
And then, yes, a couple of years down the road, you've got the equity and you can refinance out of it.
Nice.
Yeah.
Okay. So when it comes to home ownership, what are some of the pros to home ownership? A lot of people are going from renting
Sure.
to owning. What are some
Sure.
of the pros?
Yeah, so like from an emotional perspective, right, it's yours, right? Nobody can take it from you as long as you make the payments. But then inside of the home, you can do whatever you want to it, right? You can paint whatever colors. You can, have roommates, not have roommates. And then, if you want to do a remodel, you don't need to ask permission. You just got to pay for it.
New kitchen, new bathroom,
Yep.
new floors.
Yep.
Yeah.
And then from a financial perspective, right, there are tax benefits. You can, on your primary residence, right, and I'm not a CPA, but on your primary residence, if you claim to not take the standard deduction and you take the itemized deduction, then you can use your mortgage interest to write it off against your income, and that's a strategy that many people use. And then, as hopefully we're all buying appreciating assets, right? Time will tell, but historically speaking, right?
Yeah.
You look at the last 50 years, and as a whole, people have appreciated a lot in real estate, and hopefully that's going to continue the trend. So while that's an unknown, it's historically speaking, it's a great investment.
Yep.
In addition to that, regardless of what the market does, if you buy a 30-year fixed loan, a traditional Fannie Mae, Freddie Mac 30-year fixed loan, then every month as you make your payment, every month a little bit more goes to principal. So, you wake up 10 years later and then boom, you've got all this equity because of the principal buy down, right? And it's just part of the mortgage. Your mortgage will go up a little bit because your taxes will go up, maybe your insurance goes up. The principal and interest payments never going to change. Only thing that's going to change is the benefit. The principal keeps getting, the principal payments keep going up, and the interest payments go down. So, not sure if I addressed all of that or not, but yeah, I mean it's. I'm obviously biased and a huge fan of real estate investing, and that's just on the primary residence side. And I say that is often people's first real estate investment is the home that they live in. Their family is there, and it is an investment as well, because even if the market stays flat, if you buy a $500,000 house, if the market stays flat and it never appreciates, never depreciates, 30 years later, you've paid off your mortgage, and now you got a $500,000 asset.
Yeah. So with investing, let's say somebody has a primary residence and they want to buy a secondary investment property.
Yep.
What are some programs that might facilitate that?
For the people who really understand how to build wealth through real estate and are willing to move as part of that, right, to protect their cash, you can really climb that ladder and do it with little money out of pocket. So what I mean by that is there are many people in this country right now, millions and millions of people who have fantastic interest rates. And you can turn your current primary residence with your 2, 3, 4% interest rate into an investment property, right? And then assuming you qualify from a debt to income perspective, and that's a whole nother conversation, then you can move into the new home, make it your primary residence, as little as 3.5% to 5% down. And then now you've got your investment property with a great interest rate.
I love that.
That's, and some people feel like they're being forced to do that, but it's a great problem to be forced into. As a real estate investor, that's a pretty cool problem to be forced into. And my family, we love our home, but don't think that I don't think about that strategy all the time.
For sure.
Yeah.
For sure.
Yeah.
Now, when it comes to, I always was curious with this, cash out refinance versus a HELOC, a
Sure.
home equity line of credit.
Sure.
What are the differences? What are the pros and cons to each?
That's a great question. And if we look at the current marketplace, right, and the fact that there's so many people who have a 2, 3, 4% interest rate on their home, they might not necessarily want to disrupt that and refinance it into a cash out refinance. When the market is steadier and the HELOC rates and the cash out refinance rates and the current rate, when they're all similar, then it makes the conversation, it makes the cash out refinance a lot more attractive,
Gotcha.
right?
Gotcha.
But if we look at the current market, the HELOC, you take the HELOC and you put it on top of the current mortgage, and now you get to keep the old rate, and the HELOC, you can then tap into for things such as buying your next investment property, such as down payment. Again, if your debt to income allows you to do all of this.
Yeah.
The benefit of going the cash out route would be if you've accumulated a lot of high interest commercial, if you've accumulated a lot of high interest consumer debt, then your payments are high, and the prospect of getting out of that might be challenging. Kind of refinancing it all, and even if your interest rate goes up, bringing your total monthly payment down to a point where you can breathe again. And that's a different, right? Someone who's investing in real estate and someone who's maybe having some financial challenges, those are two different people in two different parts of their life. But that's why, that's just my opinion, but that's where when rates are big difference between current rate and current rate that you have existing on your house and the cash out rate, there's got to be like a real benefit to refinancing this big,
The whole thing.
yeah, $300,000 or
Exactly.
something, and that's where I've seen people win, is when they're really trying to solve for something bigger than just investing.
Now, when it comes to, let's say, like a HELOC, what the interest, like the interest rate, is that similar to what the current mortgage rates are going for, or?
Yeah, so again, I'm not quoting rates, but it's similar, but the way that the way that the rates are derived are different.
Okay.
Right? So when you buy a house, or when you do a refinance, when you buy a house, your interest rate is based on the loan program and your credit score and the property type.
Gotcha.
Down payment, until you get into the really big down payments, down payment doesn't really move the needle much.
Okay.
But on the HELOC, it's all about equity. Yes, it's about credit score, but it's really about equity.
Okay.
So, for example, I like using 100% combined loan to value, and I know we're getting very technical here, but I like using the one that gives you the most amount of cash, right? Because if you're trying to invest, trying to be nimble, you got to have the most amount of opportunity for the cash.
Yeah.
As you can imagine, the more cash, the higher the rate, right?
Makes sense.
And so the higher the cash, the more you're dipping into the equity. So yeah, I mean, the rates are, it's all kind of pegged to the, it's all correlated to the market. So yes, they're similar, but banks are going to run promotions. They're going to have teaser rates. Be careful of that. But it's also really heavily focuses on the equity portion. And I've seen like a major gap in the same company, right? Like trying to get a HELOC from the same company. If you have a small amount of equity or a large amount of equity, there's a big difference in rates.
Okay.
Yeah.
Cool.
Yeah.
I appreciate everything, man.
Absolutely.
Thank you.
Yeah,
It's been
for
a
sure.
pleasure.
Absolutely.
All right, I hope you guys enjoyed that video. That was a full conversation with Tim. He is, like I said, the mortgage loan officer. He answered all those questions really well. And it was good to just sit down and kind of ask some questions that have been on my mind. And I wanted to put it out there, and hopefully you guys got great value from this video. Let me know in the comments down below, who would you like me to interview next? And I'll try to get that scheduled. All right, everybody, you take it easy, and I look forward to seeing you in the next video. Peace.